Price chart of which represents times when the no transactions took place within a particular price particular price range. Normally this occurs between the close of the market on one day and the next day is opened. There's two primary kinds of the gaps, up gaps and down gaps. For an up gap from the low price after the market close must be higher than the high price of the previous day. Up gaps are generally considered bullish, and down gaps is just the opposite. An up gap. The high price after the market close must be lower than the low price of the previous day. Down gaps are usually considered bearish. Gaps result from extraordinary buying or selling interest developing while the market is closed. For example, if earning reports with an unexpectedly high earning comes out after the market has closed for one day, a lot of the buying interest will be generated overnight, resulting in the imbalance between supply and demand. When the market opens the next morning, the price of the stocks rise in the response to the increased demand from buyers. If the price of the stocks remains above the previous day's highs, then the up gap is formed. Gaps can often evidence that something important has happened to the fundamental or the physiologically of the crowd. In the Forex market, it is uncommon for the report to generate so much buzz that is wide the bid and ask spread to the point where significant gap can be seen. Gaps can also occur due to the technical reason. For example, the stocks breaking in a new high in the current sessions may open the higher in the next sessions. Those gapping up for the technical reasons. So what the common time frame for gaps? Up and down gaps can from on daily, weekly or monthly charts, and are considering significant when the fluid is higher than the average volume. Gaps appears more frequently on the daily charts, where every day is the opportunity to create an opening gap. Gaps on the weekly or monthly charts are fairly rare. The gaps would have the occur between the Friday's close and Monday's opens for weekly charts, and between the last day of the month's close and the first day of the next month's opens. For monthly charts, gaps can be classified into the four groups: common gaps, breakaway gaps, exhaustion gaps, continuation gaps. Let's discuss each of the types of gaps. First of all, common gaps. A common gaps is the price gap found on the price chart for the asset. The occasional gaps are brought by the normal market force. They are also referred to as trading gaps for or an area gaps. These gaps are usually get filled very quickly. Getting filled means to the price actions and later time, usually retrake at the last day before the gap. This is also known as the closing the gap. Here's the chart of the common gaps that has been filled. Noticed how following the gap the price have come down to the latest beginning of the gap. This is called closing of the filling the gap. A common gap usually appears in the trading range or the congregation area where it is reinforce the apparent lack of the interest in the stocks at the time. This is often future interest intensified by the low trading volume, because common gaps are reactively small, normal, and whatever regular essential in the price actions of all essence. They tend to provide no real analytics insights. The second type, breakaway gaps. This occurs when the price action is the breaking out of the trading range. Congestion area. A congestion area is the price range in which the market has trades for some period of the time, usually a few days or weeks. There is an area at the top of the congestion area is usually resistance, where the approach from the below. Likewise, the area near of the bottom of the congestion area is support when they approach from above. In order to break out of these areas, we need to make a simulated and many more buyers that the sellers for the upside breakout, or many more sellers to the buyers for the downside breakout. Volume will and should pick up significantly, not only from the increasing enthusiasm, but because of the many holding positions on the wrong side of the breakout and need to cover or sell them. It is better if the increase the volume does not appear until the gap occurs. This means the new change in market direction has a change of the continuing the point of the breakout now, because the new support if the upside breakdown, or the resistance if the downside breakdown. Usually this type of the gap is associated with the good volume, won't be filled soon. So finding the breakaway gap might take a long time. It's better to go with the fact that the new trend in the direction of the stocks has taken place, and straight in the directions, not against it. Notice in this example how price spent a long period of the time without going lower than the support level. When they did, it was the increased volume and downward breakaway gap. A good confirmation of the trading gaps is where or not they are associated with the classic chart patterns. For example, if the oscillating trading suddenly has the breakout gap to the upside, this can be much better traded than the breakout gaps without a good chart pattern associated it. This example should bullish ascending trading triangle with the flat of the rising and the lower trend line, with the breakaway gap the upside, as you would expect with the exact trading. Therefore the breakaway gap should the C rate at the moment out of the range. On the other chart pattern, the volume plays the important role in the strategy. A breakout gap with the larger than the average volume, or especially high volume, shows strong conviction in the gap directions. A volume increase in the breakdown gap helps confirm that the price is likely to continue in the breakout direction. If the volume is low on the breakaway gap, there's the guaranteed chance of the failure. A failure breakdown occurs when the price gaps above the base or below the support, but can't sustain the price with the move, so the back into the prior trading range. Next type, railway gaps. Runaway gaps are the best described as the gaps caused by the increase in interest in the stocks. The runaway gaps is the upside, typically represented with traders who didn't get into during the initial move of the uptrend, and while waiting for the representment in price decided it wasn't wrong going to happen. Increased buying interest helps all of the sudden and the price gaps above the previous day's close. Also, strong uptrend can help runaway gaps caused by significantly new events that caused new interest in the stocks. In this example, pay attention to the significant increase in the volume during and after and the runaway gaps. Runaway gaps can also happen in the down trends. This usually represents an increase in sell-off of the stocks. This type of the gaps occurs during the strong bull or bear moves, and this characterized by the significant price Significant price change in the directions of the previous trend. During the trend, as a securities price may experience several runaway gaps, which can help to reinforce the trend's direction. It's not uncommon for the runaway gaps to occur after the stocks has experienced a breakaway gaps. Next type, exclusion gaps. Exclusion gaps are those that near the end of the strong up or down. They are often the first signal of the end of the move. They are indicated by the high volume and the large piece difference between the previous day close and the new opening price. They can easily be mistaken for runaway gaps if you don't notice the exceptionally high volume. On exhaustion gaps, the technical signal marked by the break lower in prices that occurs after the rapid rise in the stock's price. The signal reflected a significant shift from the buying to selling activity that usually considers with the flattened demand for the stocks. The implications for the signals is that the upward trend may be around the end soon. In this case, the exhaustion gaps price gap up with the huge volume when they are the major profit taken from the demand of the stocks totally dries up. The price drop and a significant change in the trend occurs. Exchanging gaps are probably the easiest to trade and profit from. In this example, notice that were several more days trading the upside before the stocks plug-in. The high volume was the giveaway that was going to be easier exclusion gap or the runaway gap because of the size of the gap and the near tripling of the volume and exclusions gap was more likely that the runaway won. There are many ways to take advantage of these gaps with the few stringent more popular than the others. This video was basically on the introduction to the gaps trading combined with the volume, but in the future we will go deeper and we will apply to the different strategies using price actions and indicators to advantage of the gaps. As always, if you learned something new and found value, leave us a like to show your support, subscribe to our channel and hit the bell icon to stay in touch when we will upload the next video. Until next time.